What if I told you that millions of Americans invest for years, yet still retire with far less money than they should have? And the most surprising part? It's not because of a stock market crash. It's because of one simple mistake that almost every new investor makes. If you already invest or plan to start one day, this video could save you not just thousands, but potentially hundreds of thousands of dollars over your lifetime. Most people believe that becoming wealthy is all about picking the perfect stock, a company that goes up 10x or even 100x, or finding that one investment that turns them into a millionaire overnight. But the truth is completely different. The world's most successful investors didn't become wealthy because they picked the right stock every single time. They became wealthy because they avoided the same costly mistakes that ordinary investors keep making over and over again. And today, we're going to talk about the biggest one of them all. But first, let me tell you a short story, because hidden inside this story is one lesson that can completely change the way you think about investing. Imagine two friends living in the United States. David and Michael. Both are 25 years old, both have good careers, both earn around $70,000 a year, both save money every month, and both decide it's finally time to start investing. At first glance, their lives look almost identical. But fast forward 30 years, David becomes a millionaire, while Michael is still worried about money. So what happened? Did David earn a higher salary? No. Did he win the lottery? No. Was he some kind of investing genius? Not at all. There was only one difference between them, and that single difference changed the course of their entire financial future. But before we reveal what it was, there's one important truth that most people never fully understand. Whenever the stock market reaches new highs, people get excited. The headlines are everywhere. The market hits another all-time high. Investors are making fortunes. Now is the time to invest. And that's exactly when many people make their very first investment. But the moment the market starts falling, those same people panic. They think, I'm losing all my money. Maybe I should sell before it's too late. What if the market never recovers? And out of fear, they sell. That's where their biggest financial mistake begins. So, what is the biggest investing mistake? Choosing the wrong company? No. Buying cryptocurrency? No. A stock market crash? No. The biggest mistake is trying to time the market. People tell themselves, I'll invest when the market drops. Stocks are too expensive right now. I'll wait. I'll start next month. Let's see what happens after the election. I'll invest once the recession arrives. And that waiting turns into months, sometimes even years. Remember this, wealthy investors don't wait for the perfect time to invest. They let time do the heavy lifting. But now comes the biggest question. If trying to time the market is a mistake, then what's the right way to invest? Should you simply invest on any random day without a plan? Or is there a strategy that has helped millions of Americans build wealth for decades? This is where the real lesson begins. Imagine you can save $500 every month. Now you have two choices. The first option, leave that $500 sitting in your bank account, waiting for the perfect market crash before you invest. The second option, invest that same $500 consistently every single month. Most people believe the first option feels safer, but history tells a very different story. Over the long run, the second approach has consistently produced better results. Why? Because no one can reliably predict when the market will reach its lowest point. If the world's top investment professionals can't consistently time the market, what makes the rest of us think we can? Remember this, waiting for the perfect time to invest often becomes the most expensive mistake you'll ever make. That's why millions of Americans follow a simple strategy called dollar cost averaging. The name may sound complicated, but the idea is incredibly simple. Invest the same fixed amount every month. That's it. Whether the market is up or down, you keep investing. When prices are high, your money buys fewer shares. When prices fall, that same amount buys more shares. Over time, your average purchase price naturally balances out. That's one of the reasons why so many long-term investors trust this strategy. But consistently investing is only part of the equation. There's another important question. Where should you invest? This is where many people make another costly mistake. Open social media today and you'll see headlines everywhere. This stock is about to 10x. This company is the next big winner. Buy now before it's too late. And many people, without doing proper research, invest their hard-earned money. If the stock goes up for a while, they believe they've mastered investing. But when that same stock suddenly drops 40% or even 50%, they panic and sell. In the end, they lose money and learn nothing. Remember this: wealthy investors don't invest based on hype. They invest based on principles. That's exactly why millions of Americans choose to invest in index funds instead of trying to pick individual stocks. So, what exactly is an index fund? Think of it this way. Instead of buying just one company, you're buying an entire basket of many of America's largest and strongest businesses. If one company struggles, the others can help balance the overall performance. In other words, your financial future isn't dependent on the success of just one stock. This idea is called diversification. Simply put, it means spreading your risk instead of putting all your eggs in one basket. But even here, there's another mistake that many people make. Some investors say, "I want to double my money in 6 months." That mindset turns investing into gambling. The real purpose of investing isn't getting rich overnight. It's building lasting wealth, slowly, consistently, and patiently. If you check your portfolio every single day, every small market decline will feel like a disaster. But if your goal is financial freedom 20 or 30 years from now, today's short-term market swings become far less important. Remember this: market ups and downs are completely normal, but emotional decisions are what cause the biggest financial losses. Think back to the 2008 financial crisis. The stock market crashed. Millions of investors panicked and sold their investments. But those who stayed patient and continued investing consistently were able to benefit from the market's recovery in the years that followed. History teaches us one important lesson. Every market downturn eventually comes to an end. But the wrong decision made out of fear can cost you for years. So far we've learned why trying to time the market rarely works, and why consistent investing has historically delivered better long-term results. But here's another important question. If the strategy is really that simple, why don't most people become wealthy? The answer can be summed up in one word: emotions. The truth is, the biggest battle in investing isn't against the market, it's against yourself. When your portfolio is up 10%, you start thinking, "I should have invested more." But when that same portfolio falls 15%, your mind suddenly says, "Sell everything before it gets even worse." That fear, that greed, and that impatience have kept millions of people from building lasting wealth. The most expensive fee you'll ever pay as an investor isn't charged by a bank, it's charged by your own emotions. That's why successful investors don't check their portfolio every single day. They don't react to every rumor. They don't chase every breaking news headline. Because they understand that today's headlines rarely change a financial plan built for the next 20 or 30 years. Now let's talk about another mistake, one that many people never even realize they're making. As soon as their income increases, their spending increases too. A new car, a bigger house, the latest smartphone, luxury vacations, and then they say, "I just don't have any money left to invest." That habit keeps people trapped in the paycheck-to-paycheck cycle. Wealthy people don't spend every extra dollar they earn. They invest first and spend what's left. Many people in the middle class do the exact opposite. They spend first and only invest whatever happens to be left over. That's where their financial paths begin to separate. Remember this: your income doesn't make you wealthy, your habits do. Imagine two people, both earning $100,000 a year. The first person invests 20% of their income every year. The second person spends every dollar they earn. 10 years later, who is likely to have built more wealth? The answer is obvious: the first person, because they turned their income into assets, while the second person turned it into expenses. Now, here's the most important message from this entire video. If you truly want to build wealth, you don't need to find a magical stock. You don't need to trade every day. You don't need to rebuild your portfolio every time the news changes. You simply need to follow a few timeless investing principles again and again, year after year, without giving up. 7 simple rules for building wealth. Number 1, invest a fixed portion of your income every single month. Whether it's $100 or $1,000, consistency matters far more than the amount. Number 2, don't try to time the market. No one can consistently predict the future. Number 3, think long-term. 10 years, 20 years, 30 years. That's where real wealth is built. Number 4, diversify your investments. Don't put all your money into one company or one sector. Number 5, never make investment decisions based on emotions. Fear and greed are 2 of an investor's biggest enemies. Number 6, invest in yourself. Learn new skills. Increase your earning potential. Because the more you earn, the more you can invest. Number 7, be patient. Wealth isn't built overnight, but the right habits, repeated consistently over time, can produce extraordinary results. If there's just one lesson you remember from today's video, let it be this: the secret to building wealth isn't investing at the perfect time, it's investing the right way for a long time. Remember, time is the most powerful investor you'll ever have. If you let it work for you, even small, consistent investments can grow into remarkable wealth. But if you spend your life waiting for the perfect moment, you may one day realize that your biggest financial loss didn't come from the stock market. It came from waiting too long to get started. If you enjoyed this video and learned something valuable, share it with someone who's thinking about starting their investing journey. And if you want more simple, practical insights on personal finance, investing, and financial freedom, be sure to subscribe to the channel. Remember, your financial future is built by the small decisions you make today. Thanks for watching, and I'll see you in the next video.